CarMax didn't just miss earnings, it tripped over a fault line that's been building under the entire car market for years. And the shockwave didn't start with one announcement. It started decades ago with a rulebook that made car buying slow, expensive, and frustrating. Then a few players cracked it. Then Amazon showed up. But the twist is this: the biggest threat to dealers isn't only Amazon, it's the new rules of money, data, and convenience colliding all at once. And the clock just started. To see how we got here, you have to rewind to a very old promise. In the 1920s and 30s, states wrote franchise laws that tied car makers to local dealers. On paper, those laws protected small businesses from giant manufacturers squeezing them out. In practice, they locked in a middleman between you and the person building your car. If you wanted a new Ford, you had to go through a Ford dealer. That was the deal. For almost a century, that deal held. It shaped everything. Dealers controlled inventory in their zip codes. They controlled pricing on the lot. They made good money on financing, service, and add-ons. The system depended on information friction. You didn't know the invoice price. You didn't know the true cost of that extended warranty. You didn't always know if the car on the lot had been in a crash. The person with the desk and the printer did. That's how the game was played. Then in 1993, a different idea showed up inside, of all places, Circuit City. They launched CarMax in Richmond, Virginia, with one promise that sounded radical at the time: no haggling. One price on the window, cleaner stores, a big selection of used cars, clearer inspections. Over time, it got even friendlier. 7-day returns became 30-day returns up to 1,500 miles. A 24-hour test drive. CarMax made the worst part of buying a used car, the pressure, less painful. People loved it. The business exploded. In 2002, CarMax spun off and grew into the largest used car retailer in America. But CarMax didn't win because it was cheaper than every corner lot. It won because it felt fairer. And for years, that was enough. While new car dealers fought over allocations and markups, CarMax scaled the used side of the market that's far bigger than many people realize. The US buys roughly 40 million used vehicles a year compared to around 15 million new. CarMax carved out a slice of the 40. Then the internet did what it always does. First came listing sites like AutoTrader and Cars.com. They didn't sell you the car, but they gave you the information. You could compare prices across town in minutes. That alone shifted power. Next, startups tried to go a step further. Carvana offered to buy your car online, pick it up from your driveway, and drop off a replacement without a dealership visit at all. Vroom pushed the same pitch. It felt like magic the first time you did it. You clicked buy, and a week later a truck rolled up with your car. You had 7 days to return it. The vending machine towers were a stunt, but the core idea, skip the dealership, hit a nerve. And here's where it gets wild. Carvana wasn't always cheaper. Many times it was $2,000 more than a comparable car at a local lot. People paid it anyway. That told the market something simple and dangerous: convenience was worth real money. If someone could deliver both convenience and a better price, the old model wouldn't just lose, it would vanish. Then 2020 broke the math. A global chip shortage cut new car output. Fewer new cars meant fewer trade-ins, so used supply dried up. Prices exploded. The Manheim Used Vehicle Value Index, a quick way to track wholesale prices, shot to records in 2021 and early 2022. Imagine a used Honda Civic that cost $15,000 in 2019, now listing for $20,000 to $22,000. A good used Ford F-150 that used to sell for $30,000 could cross $40,000. It felt upside down. At the same time, interest rates were near zero. Cheap money made monthly payments feel manageable despite those higher sticker prices. Lenders stretched terms to 72 and even 84 months. Negative equity, the amount you owe above the car's value, quietly piled up. The average car on US roads got older than ever, passing 12 years. Prices were high, loans were long, and then the tide turned. In 2022 and 2023, the Federal Reserve hiked interest rates to fight inflation. That changed the car market faster than any website could. Used car APRs jumped into double digits. For many buyers, 11% to 14% became normal. On a $25,000 used car with 10% down, the monthly payment could swing by a couple hundred $1,500 compared to 2021. That matters. On the ground, shoppers backed away. Dealers holding expensive inventory borrowed on floorplan lines of credit, basically short-term loans to keep cars on the lot, saw their interest costs surge. If a truck sat for 60 days, that carrying cost ate into the margin every week. Suddenly, the model that worked in 2021 didn't work in 2023. CarMax felt it first and worst because of its size. In earnings calls, management talked about affordability, units sold slipped, gross profit per car was pressured. CarMax Auto Finance, the in-house lending arm that used to be a profit engine, had to price higher risk at higher rates. Credit losses ticked up as some buyers stretched too far. Expenses didn't shrink as fast as demand. The stock jolted on each report. It wasn't one bad quarter, it was the slow grind of a market that had gotten too expensive to move. But wait, this next part changes everything. In late 2023, Amazon announced that it would list and sell new Hyundai vehicles on Amazon starting in 2024, with actual delivery and paperwork handled by a local dealer. It sounds small until you think about what that does. It puts a buy button where you already buy almost everything else. You can filter a Tucson or an Elantra like you filter a TV. You can check out with financing integrated on the page. You can choose pickup or delivery. The dealer still exists because franchise laws still exist, but the front door is now Amazon's front page. That single move shifted expectations overnight. It told consumers, yes, you can shop for a car like you shop for sneakers, and it told dealers, your showroom isn't the first touch anymore. To be precise, Amazon isn't breaking franchise laws by selling new cars directly as a manufacturer would. It's acting as a marketplace and funneling the lead and the transaction to a participating dealer. That matters legally. It matters less to the person tapping place order. And here's where it gets crazier. Amazon isn't just another website. It is a habits machine. It taught us to trust arriving Tuesday more than any human promise. It built one-click checkout. It mastered delivery, tracking, and returns. Now scale that to cars. A car isn't a toothbrush, but logistically it's a bigger, more expensive package with special paperwork. On the software side, Amazon already knows how to surface what people actually buy, not what they say they want. It can rank by total cost of ownership, the full cost of owning a car, not just the sticker. That includes fuel, insurance, maintenance, and depreciation. Traditional listings show a price. A better listing shows a life. If you put two cars side by side and make that life obvious, decision-making changes. Take a 2019 Toyota Camry Hybrid and a 2019 Toyota RAV4. On the used market, their prices can be close, often around the low to mid $20,000, depending on mileage and trim. The Camry Hybrid averages roughly 46 to 52 miles per gallon. The RAV4 hovers around 28 mpg combined. If you drive 12,000 miles a year at $3.75 a gallon, the Camry might cost about $865 per year in fuel. The RAV4 is closer to $1,600 over 5 years. That's a $3,500 to $4,000 gap just in gas. Add insurance and maintenance differences. Sedans often cost a bit less to insure and maintain than compact SUVs, and the spread widen. If the screen shows you the 5-year picture clearly, that SUV premium becomes a choice, not a surprise. Now compare a 2018 Honda Civic with 35 mpg to a 2018 BMW 3 Series with about 27 mpg and higher maintenance. The Civic's 5-year fuel cost at 12,000 miles a year might sit near $1,450 a year. The BMW could be around $1,900. On maintenance and repairs, the Civic might average a few $100s a year. The BMW can jump higher, especially out of warranty. If a listing platform shows reliability scores and expected out-of-pocket costs in plain language, it doesn't just sell cars, it rewires demand. Dealers could show all this, most don't. CarMax shows some of it. Amazon can make it default. But what about used cars? Because that's where most profit sits. Here's the truth, Amazon isn't running a secret used car operation with rental fleets on the side. If you saw headlines about Hertz, they weren't about Amazon selling Hertz cars. In 2023 and 2024, Hertz unloaded lots of vehicles, especially EVs, through partners like Carvana. Amazon's move is different. It's putting the buying experience in a place where customers already are, and it's doing it with brand new cars first to get the pipes working. Once those pipes exist, search, financing, identity, delivery scheduling, turning on more inventory sources becomes a matter of adding sellers, not reinventing the process. Meanwhile, the old system is showing its seams. Franchise laws that block manufacturers from selling new cars directly don't block retailers from hosting a sale. They don't block a marketplace from routing orders to dealers. They don't block used car transactions at all. That's the loophole. That's why every dealer group watched the Amazon Hyundai rollout so closely. If customers like it, other brands will follow. Once a few follow, consumer expectations reset. And once expectations reset, every other experience that doesn't match feels broken. So where does this leave CarMax? In a squeeze. On one side, traditional dealers can lower prices on used cars when they need to move metal. They already own local service relationships. On the other side, platforms can scale convenience faster than any brick-and-mortar chain. CarMax sits between them. It built an omni-channel system over the last few years: buy online, pick up in-store, home delivery in some markets. It offers 30-day returns and 24-hour test drives. That's good. But in a high-rate world where every point of APR matters, the spread that funded all those perks narrows. Floorplan interest costs rise, marketing costs rise, acquisition costs rise. If the car sits in inventory, margins get eaten, and the buyer is not the same as in 2019. Buyers are cautious. Many are underwater on their current loan, owing more than the car's worth because prices were inflated in 2021 and 2022 and then eased. Average negative equity for trade-ins has hovered around $5,000 to $6,000. That makes it harder to swap. The average monthly payment for a new car climbed over $700. Used sits lower, but with double-digit APRs it still stings. And repossessions have ticked up off the lows as stimulus savings ran out. It's not a crash, it's a slow pullback. For a high-volume retailer like CarMax, slow is worse than sharp. It lingers. But what if I told you the biggest change isn't price, it's rhythm? Amazon moves markets by changing the tempo. It makes people expect answers now, delivery dates now, return labels now. The car business runs on, let me talk to my manager and come back tomorrow. That gap between digital speed and dealership pace is where the disruption lives. Tesla showed the first path through that gap. It built a direct model where you order a car online at a posted price and a local delivery center hands you the keys. No haggling, no mystery fees. It ran headfirst into state laws and fought carve-outs, sometimes shipping cars to nearby states for delivery. Customers didn't care about the legal dance. They cared that the process felt like buying a phone. Tesla's satisfaction scores on the buying experience crushed the average dealer because the bar was low. But Tesla has one company's production. Amazon can sit across brands and inventory. Tesla proved people prefer this. Amazon can scale it. Now layer in something the industry hates to talk about. The real unit of profit for many dealers isn't the car. It's the F&I office, finance and insurance. That's where loans, extended warranties, gap coverage, paint protection and all the extras live. A good back office sells you features you didn't plan to buy. On a typical deal, a few $1,000s of back-end profit is normal. That's why you sit in that chair for an hour. The system tries to turn the meeting into margin. In a transparent online flow, upsells don't vanish, but they get exposed. You can read the warranty terms, you can compare APRs, you can toggle gap insurance off and see the monthly number drop. The more that happens on screen, the less mysterious profit hides in the back. The more you see, the less you pay for confusion. Let me tell you this, the next 12 months won't be decided by flashy vending machines or viral headlines. They'll be decided by 5 boring levers: inventory, interest, information, delivery, and trust. Inventory is simple. Who has the cars people actually want at prices they can actually pay? In 2021, the answer was almost no one, but you'll buy anyway. In 2024 and 2025, the answer is shifting to whoever can move aging stock without getting crushed by floor plan costs. That helps the fastest movers, platforms that can route a car to a buyer with fewer days on lot win. Interest is pain. A 1-point drop in APR changes demand more than 1,000 clever ads. If the Federal Reserve starts cutting rates, used APRs could drift down. That would help CarMax, Carvana, and every independent lot. If rates stay high, even a perfect customer experience will hit an affordability ceiling. That's what slammed CarMax's units in the first place. Information is the wedge. If one platform makes total cost of ownership obvious, it will steer demand demand to cheaper to own cars. Hybrids with strong MPG and low maintenance, Camry Hybrid, Prius, Accord Hybrid, will gain share versus thirsty SUVs unless gas prices crash. A 2017 Prius averages over 50 mpg at 12,000 miles a year. That's roughly $900 in gas. A comparable compact SUV at 27 mpg almost doubles that. Over 5 years, the difference buys you a lot of tires and oil changes. If that math sits on the page, the market tilts. Delivery is the bottleneck. Moving a 4,000 car is not like shipping a phone. You need carriers, title work, local DMV coordination, and someone to hand over keys. Amazon has the software and logistics network for parcels. For cars, it will lean on dealers and third-party carriers. The company that turns this flow into a 3-day promise without disaster wins hearts. Trust is everything. If a car shows up with a surprise, the relationship dies. That's why inspection quality, reconditioning standards, and fair return policies decide winners. CarMax built trust on those pillars. Carvana rebuilt trust after a rough stretch by tightening inspections and emphasizing 7-day returns. Amazon knows how to run returns at scale, but returns for vehicles are expensive, so they only work if the inspections are bulletproof. You thought that was big? Try this. The platform that wins can influence what gets built. If a marketplace proves that hybrids with 45 mpg and low depreciation fly off the page faster than heavy SUVs, manufacturers notice. They adjust production, they shift incentives, they feed the machine that feeds them customers. That's not science fiction. That's what happened with smartphones and app stores. Distribution power shapes the product. So what should you watch in the numbers? Start with days to turn, how fast a retailer sells a car after acquiring it. Faster is better, especially when interest rates are high. Watch average gross profit per unit. If it falls and volume doesn't rise, the model is under pressure. Watch credit losses in captive finance arms. If defaults creep up, lenders pull back or raise rates, which slows sales even more. For context, CarMax's captive finance business became more cautious as rates rose and losses normalized off low 2021 levels. A healthy KF means smoother approvals and more deals. A cautious KF means more declines and fewer completed sales. That feedback loop matters more than any ad campaign. Keep an eye on inventory mix. If a retailer leans too heavy on trucks and big SUVs when gas prices rise, demand softens. If it balances with hybrids and efficient sedans, it can meet buyers who are chasing low monthly costs. In 2024, the average age of the US vehicle fleet hit about 12.6 years. That means there is pent-up replacement demand. But affordability is the gatekeeper. The cars that meet the gate, reliable, efficient, not luxury priced, will move first. Reliability is the silent killer of budgets. A 2016 Toyota Corolla with 100,000 miles can be boring, but boring is cheap. Expect maybe $400 to $600 in routine maintenance if it was cared for. A 2016 German luxury sedan with the same miles can turn one $1,200 repair into 3. Platforms that bake in simple reliability scores and sample repair costs will save buyers money and earn loyalty. They will also annoy sellers of high margin, high maintenance metal. That's fine, the buyer wins. But wait, this next part changes everything. Electric vehicles complicate the used market. New EV prices have come down in some segments, and discounts are common. Used EVs have fallen even faster in price because batteries age and buyers worry about range. Hertz flooded the market with used Teslas when it cut its EV fleet, pushing prices down more. For a buyer, that can be a deal. A 3-year-old Tesla Model 3 might be thousands less than a 3-year-old gas BMW. You'll pay far less for fuel at home, maybe the equivalent of 90 mpg if you convert energy cost. But you need to know about battery warranty, charging access, and tire wear. Those are simple points to explain well in a listing. Whoever explains them well wins trust with first-time EV buyers. So is Amazon going to destroy CarMax? Not overnight. CarMax has deep experience, strong brand trust, and a national footprint of reconditioning centers and stores. It can buy cars from consumers at scale and resell them fast. It knows how to fix and photograph inventory. It has a real return policy that people use, those are most. But Amazon is going to change the entry point for millions of buyers. When the journey starts on a platform that strips out confusion and shaves time, the last mile must adapt. The dealer who plays nice in that ecosystem survives. The one who fights every click loses. There's also a simple money truth you can't ignore. Amazon can be patient, many dealers can't. A local independent lot that buys a car at auction for $12,000 and lists it for $14,500 needs that $2,500 spread to live. It It can't eat negative gross profit for long. A national platform with scale can sometimes trade short-term profit for long-term market share, at least in specific categories or regions. If it does that while interest rates stay high, the squeeze gets ugly for the smallest players. But let's be clear about one thing. The laws aren't vanishing tomorrow. Franchise rules still dictate how new cars move. Titles still pass through the state. DMV lines still exist. Insurance still binds. A marketplace can make the experience smoother, not magic away regulation. Think of Amazon as pressure, not a bulldozer. It pushes everyone to speed up, to be transparent, to respect your time. It doesn't erase the dealer. It makes the dealer compete on the parts you can see. So what happens next? Expect a rush to look like the future. Dealer groups will launch buy online portals that try to copy the flow. Some will be great, some will be window dressing that dumps you into an old school appointment. Expect more brands to test Amazon-like partnerships. Hyundai moved first because it's aggressive on digital retail. Others hate being first but hate being last more. Expect used car platforms to double down on inspections, warranties and clean returns because trust is the moat when prices are tight. And expect prices to keep sliding towards sanity with bumps. Wholesale values cooled in 2023 and 2024 off their peak. Retail used prices followed, but not perfectly. If rates ease late 2025, you could see a weird split, prices stabilizing or rising a little even as monthly payments finally feel better. In that window, the winners will be the ones with the right mix of efficient vehicles, fast titles and clean checkout. The losers will be those holding inventory nobody can afford to fill at today's APRs. There's a human cost tucked inside all this. Small independent dealers who survived 2008 and the pandemic are now staring at a fight they can't win with hustle alone. When buyers expect 3-click checkout and clear pricing, the lot with a paper tag printer and a handshake loses ground, even if the owner is honest and the cars are good. This isn't about good guys and bad guys, it's about gravity. Convenience wins most of the time, and the gap is widening. And here's where it gets wild. The platform era doesn't end with how you buy a car. It spreads to how you own it. As pricing gets clearer and delivery gets easier, subscriptions and short-term ownership options grow. You may not subscribe to a car like Netflix, but you will see more 3-year leases with transparent early exit math, more short-term insurance that you can toggle in an app, and more maintenance bundled into monthly costs you actually understand. Once the checkout is clean, the rest of the stack follows. Through all of this, CarMax has a path. It's not glamorous, but it's real. It needs to be the best at buying cars from consumers fast at fair prices, the best at turning those cars quickly with low reconditioning cost, and the best at telling a simple, trustworthy story on every listing. Condition, ownership history, expected costs, return policy, and delivery date. It needs to keep the promises that matter, no surprises, on-time pickup, money back if it's not right. If it does that while trimming costs in a high-rate world, it can weather the pressure. If it tries to match Amazon on everything while carrying the weight of dozens of service bays and acres of lights, it will be stretched too thin. The bigger truth is this: the car market didn't break because Amazon showed up. It broke because prices soared, rates spiked, and the old way of selling kept people in chairs for hours to harvest confusion. Amazon is the messenger with a map to a faster route. Consumers were already walking that way. So the next time you see a red line on a stock chart for a car retailer, don't only think about headlines. Think about a family trying to keep a payment under $500. Think about a buyer comparing a 50 mpg hybrid to a 25 mpg SUV and doing the math out loud. Think about a seller choosing where to list their car based on how fast they'll get paid and how simple the pickup will be. That's where this market lives now. But wait, this last part matters most. If the buying experience becomes truly transparent, if platforms force every fee into the light, if every car shows its 5-year cost, if delivery windows are real, then dealers who add real value will stand out again. A great service department that solves problems fast will win repeat business. A store that delivers a fixed car on time earns loyalty. A brand that builds vehicles that sip gas, hold value, and don't break keeps customers for decades. In a world where everything else is equal, reliability becomes the star again. We're not at the end of dealers, we're at the end of fog. The winners on the other side will move fast, show everything, and keep their word when the truck pulls up. And if you're wondering whether Amazon will destroy the old model, ask a simpler question.
What happens when the place you already trust for everything else teaches you to expect the same speed and clarity for a $25,000 purchase as for a $25 one? That expectation doesn't go away. It spreads, it pushes, it pulls. CarMax's warning wasn't a headline, it was a timestamp. The era of confusion as a business model is closing. The era of show me the whole cost and get me my car by Tuesday has begun. Now we get to see who can actually do it.